all the regionals. Now, what our data showed about, I want to say maybe 5 or 6 months back, maybe it was longer than that. I just don't remember because I write these things, and I just can't remember. I'd go crazy. But sometime back, the data sets were talking about how the failure would occur, and that it would start at the mid-tier, at the regionals, that they would go first, that banks that had, several hundred branches were maybe across a couple of states, they would be the ones that would be bled dry first, and the chaos would start with them, ATM closures and all of this sort of thing. They're going to try and maintain the big five as long as they can. As I say, the dinosaur just doesn't know it's dead because the last of the blood's still being pumped up its neck. We've had the credit freeze in the data for couple of years at least, maybe longer than that. It was in very long-term data. Now we're getting into the details as we move closer to the event. That's basically how our system works. For some reason, well, no, it sort of makes sense in a way. Humans are psychic about, some humans are psychic about events in a long-term way, and we get hints about stuff that might happen 3 and 4 and 5 and 10 years out. The closer we get to it, apparently more and more humans are on the same wavelength, and they start picking it up, and we get greater number of leaks. Therefore, we get a little bit more detail. That's like our short-term data. And as we get real close to it, lots of people can sense it, and so they start triggering their psychic impressions, and those come out, and so we get a little bit more details. So that's sort of the mechanism by which it goes. So we've had credit freeze for a long time, and fundamentally one of the major side effects that you and I will experience is what we call the just-in-time failure, the just-in-time supply system. You have to think of 1940s, end of the war. Peter Drucker goes to Japan. He creates in Japan because they were just destroyed. He helps MacArthur rebuild the country, and they decide on a model called the just-in-time supply system. And that's where the carriers, the truckers, basically, are your warehouses. You just don't build warehouses anymore. You sell off all the property and you devote the money to a different system. That's where we're at now. The Western world adopted this model over the 50s, and it's now going to fail. It depends on ever-increasing cheaper energy, ever-increasing cheaper credit. Neither of those is true anymore. So we won't be able to do that. In fact, it's already started to fail. The top shipper, second shipper globally, Hanjin, number 2 shipper of goods around the planet, is in bankruptcy and in chaos, and its ships are not hauling anymore. Doesn't seem to matter because no one's buying so much anymore here in the U.S. because of our problems with our money being so destroyed. But the credit freeze will take that up to the next level as number 3, 4, 5, and 6, and number 1 shippers fail. And then when they fail, they'll be failing under the impetus of the, they don't have credit to pay their employees nor to front the fuel costs, etc. So we're going to see real chaos as loads get, ships and loads and crews become, abandoned and stuck in various ports, and the system breaks down all around the planet. And so that will be a very major concern, is the just-in-time supply system is going to fail. That's what the government's going to be responding to. They're not going to do much in the way of trying to deal with the foreclosure issues insofar as what we see in our data. Because imagine, okay, here's a scenario. Now, I'm not saying that all of the description here will be accurate, but this will give you an idea of what we're sort of looking at. Imagine a situation where Trump's being installed. He's not bringing in cronyism. He's not bringing in a giant mass of crony-connected, deep politicians. Therefore, these guys don't know a damn thing about running a giant government, which is not like running a real business. And so there's going to be a period of adjustment that will probably last 18 months or longer because the deep state is going to be obstructing and fighting these guys every step of the way, and then when they're taking a break from the fight, the deep state's going to be trying to pull the rug out from underneath them, just standing there. It's going to be very vicious at that level. These individuals will not be able to address, that is to say, the people that are being brought into a new government will not be able to address the real problems that are besetting the populace in their fight with the occupying banks. And so at the same time, we're going to have the just-in-time supply system crash because those same banks are the ones that fund this weird credit system that gets the McFries to you and, puts, potatoes on the table and that kind of thing, right? So there's going to be people that are at the top that will certainly be freaking out about everything that's going on and trying to do everything they can. But I don't really necessarily, and they are what we sort of think of when we use that word government. But government's got a huge connotation. It's everything from the El Presidente all the way down to the FEMA guy that's either going to give you a bottle of water or throw you into a camp. And so what are we actually talking about? They're desperate to do that because the banksters don't want to admit well, let me stop and say humans are really funny. We always bring on ourselves, because of the nature of universe, that challenge that we need to face. And so here the bankers are trying desperately to destroy cash. And if you think, if you have all of these people out on the internet that are offering ideas as to why this is the case, that they need more control, et cetera, et cetera, et cetera. And if you only have digital things, they can control you down to your nads and, pull you on the short hairs by threatening to do away with your bank account. And none of that is true. Or it's all true, but none of it is meaningful. The bankers are trying to destroy cash as their part of the system because they're vulnerable to it. They're hugely vulnerable to it because there's only a little tiny bit of real money these days and a huge amount of derivatives on that real money that actually exists. And so the problems that they have are cash-based, but not the way we think. We're going to have a cash crisis, and it's because there is not going to be enough money, actual currency, circulating through the real economy to support their paper games anymore. They were trying to get us all to shift into their virtual sim world and play with their sim money 100% of the time and get away from the cash that really is the underpinning. If you look at this thing called base money supply, you see how vulnerable we are. We have a population that's hugely inflated. It's twice the size as it was in 1947. We have a debt structure that's perhaps 100 times inflated over what it was in 1947, but we only have 2% more actual circulating money going on in society, and that's where economy actually exists. And what they were hoping to do was to speed up circulation by making it all digital. And they've got us all into a digital world, but they're still dependent on that base money, and it's got them got them by the short hairs. And so we're going to run into a big crunch here, a big credit freeze, at the same time that we find we're cash strapped. That same deflationary wave has caused hyperinflation in Venezuela, Argentina, Zimbabwe, Kenya, Hungary, Uzbekistan, and so on, and now it's about ready to hit Europe. It'll hit here probably March or April. We'll start getting into the hints of hyperinflation. Right now, how often do you actually touch anything close to money in your daily life? I mean, you as an individual. Mostly the people that are, say, even in my age group, they're dealing with the plastic cards. And as the system locks up, if your plastic card doesn't work, how are you going to pay for something at Safeway or Starbucks or someplace, or buy gas or whatever? For a while, there will still be stuff in the supply system. So we live right now without warehouses. So if we were to look at ourselves as a social body, we don't have big giant fat repositories lying around. We're existing on the fat that's being pumped around in our blood, and it's going to dry up. Our blood's going to get leaner, and so at that point, we don't have those extra reserves, and you're going to run into this situation. It's hit all of the countries as the dollar has died. We're in an empire. The empire is based on the dollar, the way the British Empire was based on the pound sterling. We're replicating history. This happens all the time. Empires die from the periphery. Part of our periphery was Argentina, Venezuela, Greece, Hungary, all these countries that were dollar-based on their own currency. So we see it there first, so let us not be surprised when it hits, Florida, New Hampshire, California, et cetera, et cetera. My apologies to you if you're popping in and listening to me for the very first time. But in any event, so at the moment this is a recording for a metals. Let's start off here with our Ponzi scheme of the paper debt markets and the U.S. dollar, all of these kind of things, and their relationship to the monetary metals of silver and gold. You'll note within our data sets that we had this very prescient, scary prescient, scary accurate, so far anyway, set of circumstances in which the data set said we're going to go up through 408, come down, go back up, come down, go back up through 408 again, and then bounce around a lot, and then go through 428. And that the day we went through 428, that was the day that silver was going to start this rise. Now, we note that that did occur. The 408, initial couple of 408s were in the early part of November. We did have the word rapid with the transit through 408 3 times for Bitcoin. Sorry, this is all about Bitcoin, and it's cross-linked over to silver. But the Bitcoin transit through 408 U.S. dollars up through 428 in this range was spoken of in the data sets as a bespoke data set that went through it and said we'd go through it 3 times. in a rapid fashion. And I think we have to agree that in the markets, something occurring over a course of a month is probably fairly rapid. And that once we went through 428 and there was a floor established for Bitcoin at 428, then we would also have established a floor for silver. And apparently that is the case so far. We'd been up and down through, revisited 428 a number of times. Yes, we'd gone through it and stayed above it, but every day we were coming back down and retesting it. I don't follow these things that closely, so it was only by looking at a chart of the last week of the action that you can actually see that occurs. And then we go through 428 on Bitcoin and we hold them and then we stay up there. Now, the connection to silver was that silver has virtually the same emotional profile in our work, in our webbot work, and you should go check us out at halfpasthuman.com if you're unfamiliar with this, if you're running into this for the first time. The Bitcoin was going to go through 428. It was going to hold 428 as a floor, and on that day we would also have a floor that was set up for silver. And it would just be coincident. I mean, they're not linked, and it's, one doesn't cause the other or anything. But within the prescient level, within the forecast of what we were doing, they were temporally coincident. And it seems that that's the case, that whatever it was, 1338 or 1362 or whatever number it was for silver on that day, that's apparently going to be the low. And it's just interesting that the way that this all worked out, we have this occurring about the same time as the Fed meeting. Now, the forecast for the 408 through 428 range goes way back, like July, August, when we first started discussing this sort of thing, and then it really developed over September. And got into the details in September and shared those, and it's been out on the internet, and everybody said I was crazy, and well, coincidentally, maybe I was quite crazy, but it did indeed work out that way, that Bitcoin coincidentally transited this range 3 times through the 408 to 428, and then went up, and we had this apparently the beginning of the rise in silver. I understand that silver went down. Manipulation and that kind of thing is not an issue. We're not talking about it going up every day. We're talking about a significant rise reaching a plateau in silver. Now, the language for the significant rise and the reaching a plateau for silver is coincident, temporally coincident again with a major developing debacle within the paper debt markets. And the debacle is basically a shredding or a crumbling, corroding. Some of the other words we had would relate to the market ending up looking like Swiss cheese, big holes being punched through it. They're just all kinds of descriptors for the market basically getting shredded, just getting crushed over a period of time that brings it up to March and April of this coming year. And by the market, I'm talking about the U.S. equities market. That's the one that's being referenced most normally within our data sets, simply because we started off in English so long ago. Anyway, though, it comes on up to the Dow and all of this kind of stuff, the USA paper debt markets going into a big fall over the course of 2 months in March and April of 2016. Now, the plateau in silver is reached prior to that. That is to say that silver, according to the data sets, will rise up significantly. And I'll get into that word set in a minute. But it'll rise up significantly, and then it'll reach a plateau that holds as other events take over all of our minds and occupy what we're paying attention to, and as the mechanics of the silver market break down, and or the precious metals market. So the holding in price language is really referencing not everybody deciding, okay, it's worth this much and no more, $60, $80, it doesn't matter what it chooses to be the price. Then the numeracy is not pertinent. The emotional descriptors go to the idea that people would like to buy silver, they'd be willing to pay more for silver, but the mechanics in the market actually break down such that nobody can trade silver, and thus we have a period of time in which we have a plateau that is going to be, according to the data sets, a very interesting, very tense, worrisome time, et cetera, and will break in a reasonably short period, about 35 days, and it breaks because of something else, because of a new development, which I won't go into at this point. And the quote price discovery during that period of time is pegged. It's just simply held at what the last price was. No silver is trading. In the gold market, during that same period of time, the language is describing the gold market as having gone no offer, meaning nobody's offering gold for sale. There'd be plenty of people offering money to buy it, but nobody's willing to put out, plenty of people offering currency to buy it, but no one's willing to sell their gold, which is money. And so we get this period of no offer. Now, the no offer on gold goes a lot longer than this temporary market breakdown for silver that the data is forecasting for this upcoming year. I'm getting into a lot of the stuff that's in our upcoming report for January. So if you want more details on this kind of thing, you can go and check out our report when it comes out. But I thought I'd give everybody a little bit of a preview and skirt and dance around some other issues for reasons that you'll find apparent here. Now, the rise in silver, the wording we have on the rise in silver is the word is significant. So that's the descriptor set. I'm sorry, in terms of the set, that's like the label at the very top, and then we go into this little pyramid of gradually increasing detail as we go further and further and further down. As we get closer and closer to the event, we gather more of the detail language, and so we can get a broader, much more emotionally descriptive set of words as opposed to simply significant. Because bear in mind, I've been discussing this rise in silver, this particular rise in silver for this year based on the Bitcoin coincidence temporally in this particular range. I've been discussing this since August. And so the word significant over the time, that descriptor set has grown, and we now have a much more clear picture of what the data is trying to describe. And it's not talking about, it's describing the action for silver relative to what we might think of as like chart patterns, as opposed to giving me any particular set of numbers. Sometimes we get numbers. That's very rare. So the 408 to 428 for Bitcoin was extremely rare. It comes up maybe once a year if we're lucky in our work. It's because we throw out most numbers, and very few numbers on the internet are actually typed out as numbers and come through as words. So it becomes a problematic issue. When they do appear, they're really important, as we've discovered when it forecast 300,000 dead in the Banda Aceh quake 8 months before it occurred. That number was incredibly prescient. So numeracy, when it actually occurs in a textual description of a numeral, we do pay attention to. Now, we do not have that for silver at the moment. Previously, we had indications that it would be about $62 to $68 at the time that it went into a plateau. Now, those numbers came up before the descriptors for the significant rise, the Bitcoin, and the flow that led us to where we're at the moment. That is to say, the conjunction or juxtaposition of our particular forecast with the events as they've unfolded. So I made forecast back in August and September about what would be happening with Bitcoin when silver started to go up. Silver did nothing until the Fed made their error. But now bear in mind also, we've been describing the Fed's decision as being an error way back in August. We were describing that they would make a bad decision at the end of November time period that would really affect everything. In any event, though, so the word significant in this case is being linguistically described in a fashion that we could read as a chart. And if we were to look at this in that language in a chart manner, then we would see that the actual cash out of your pocket to obtain some silver in the upcoming months when we reach the plateau will clearly be double what we're looking at now. So in that sense, that's the minimum level of what we see as significant within the descriptor set we've got right now is a 100% increase in the actual cost to take delivery of that ounce. And I say that, and I say this because we're not looking at, the data doesn't know about spot price versus on the street market delivery price or eBay or any of that. It describes this sort of stuff in a very much broader fashion. And the way in which it's actually describing it literally is actually getting it in hand. So we have the in hand and out of pocket language, this kind of thing, to say actual costs involved, and delays it because it also speaks in cost and time and energy. Not in this particular instance, but in other cases we'll see the data come up with things about the cost and energy. But in this case, we've got a cost in time to obtain silver, and we've got a cost in currency. And the data sets are referencing the significant step up, which is going to be clearly, which is now more clearly described as being what we would think of as like 100% increase. Now, this may not be 100% increase in the spot price. I have no way of knowing that. What we're looking at is a actual cost to get it into your hands. So if right now you had to pay $22, including shipping, to get an ounce mailed to you from the local or through internet, through what are they called, the primary dealers or whoever these guys are that get it from the mints, then you could figure that we'd be looking at $40 or $45 to get that same ounce at the time that we hit this plateau before the mechanisms break down. That could be a couple of weeks, it could be a couple of days for all I know, but because we don't have a description of it that way, our description of it is that we basically take these series of steps up, not crocodile teeth the way you have this up and down market action. True, there will be down days, and some days where you go up one day and then the next day is deliberately engineered to get you even with the day before, and so there's no gain. So it talks about that in the data sets. But overall, we're going to be reaching towards this significant rise, which we'll see as a 100% increase in the actual cost of getting it, what you got to dig into your pocket for to get that ounce of silver and actually have it in hand. And in that cost, it's also talking about time delays, which in some cases could be many weeks. So we have a clue there as to how long the period of time for the rise will take relative to the period of time for the plateau. I hope that makes a lot of sense, or any sense at all. Linguistically, we have to hook all these clues together in a Sherlock Holmes fashion, construct a narrative in our head, test it against the model, test it against reality to make sure that that there's at least some hope in hell that it'll appear, and then then we put it out in our reports and cross our fingers and we see where we're at. And it's usually a little bit better than chance. Actually, it's in some cases quite a bit better than chance, and we've been really pretty good because of the lexicon tuning I've been doing, which I won't go into at the moment. But so to finish on the silver issue and the gold issue, we're going to go over these period of rises, and then we're going to hit this market pegging period, which is temporally coincident with and flows into our paper crumbling, crushing stuff that culminates in a March-April destruction, really huge level of destruction of debt at the paper level and disruptions. We have data sets for things like countries' postal systems being shut down because there's no money suddenly to fund the people that are trying to deliver the mail. Not necessarily U.S., but it'll be hitting the language. So we have all of these kind of language, all this kind of language for a great deal of disruption during this period of time, and it gets worse from there, of course, but these are some of the signs that we'll see that we're entering into this just very terrible period of time, this year of manifestation of your worst fears, probably. In any event, though, so that's it about the precious metals at the moment. Just to let everybody know where we're at, we've actually linguistically fulfilled the Bitcoin range cross. We've set apparently set our floor for silver. It's going to start rising over the next period of time into this until it reaches a plateau, and then it's going to smack out as and just sit for the maybe 35 trading days, we think. There's just some indications of that range. And at that point thereafter, then we hit a really interesting period with hyperinflation, and the silver price goes crazy along with the prices of a lot of other things. But there's going to be a huge chunk of debt destruction. I don't know if that qualifies as deflation, but it certainly is going to be devaluation. That's going to go over the first quarter and into the end of this March-April downturn. So that's where we're at. If it helps to know that, better act on it. We're getting so close. Things are manifesting right and left. It's not a question of if. It's a question of when now. My WebBot forecasts are forecasts of the future that are prepared by a process of predictive linguistics that's basically deep data mining on the web, and it obtains some pretty spooky results. I've been asked to provide 3 reasons to read these reports because they're somewhat long, and the world's big, time is limited, there's much more interesting and fun things to draw your attention. So this guy has a legitimate question, He's saying, why should he waste his time? And so I decided to make this video and say, okay, here's why. And rather than go into all these different kinds of reasons, I just decided to give you 3 examples, 3 reasons in a sense. Well, sort of 2 reasons and an opinion. You'll see when we get there. Today, by the way, is August 20th.
2016. As with everything I do, time is important, so sometimes in the future it's going to be necessary to note this. I'd received an email from this woman who's been reading my reports for a long time. She came across them in 2008, I think she said, and maybe it was early 2009. It was right after the financial crisis. This last one got really rolling. She just retired maybe a few months before it had happened, had fortunately sold her house. She was a school teacher. I won't go into all of the details, but she sold her house before everything really went kablooey in the real estate market, and so she had a bit of money besides her very, very meager pension from being a school teacher for most of her life. And so she started reading my reports in, as I say, about 2008, 2009. I first heard from her mostly recently, about, say, 2 years ago. Anyway, so the situation was she had some money. She had a retirement account, and she realized by sometime in 2009, 2010, that her money was being eaten away faster by the banks than by her spending it. And so it was a real problem for her. Oh, by the way, she found my reports because she was looking for the most pessimistic view she could find, because she said, obviously, we're into it in a deep way in 2008, and she wanted to see stuff that was beyond her level of thinking so that she could get a bit prepared. And, you know, at that point, you really didn't get much more pessimistic than my reports, because we were deep into it, and that's all that the reports were generating. Anyway, so she stumbles across my reports, and she tells me she was fascinated by so much in it, she kept reading it long after she got the gist of the economic stuff, and she just kept getting them year after year. Anyway, so as I said, her retirement was getting eaten away, and then she said one day in 2012 she just decided to do something about it. She had the nest egg that was just being eaten away. It was from her house. She was living in a rented place at that point, and it was being eaten away too by inflation and not being able to invest it and get any return on her income. So she decided to do something that I've been talking about in my reports in 2012 and since then. And in 2012 I was really big on it. And yes, you got to do this. You got to do this, guys. You really got to do this. And because at that point I was convinced. Now, I'd run across this way back when, but it took me a couple of years to be sure that I was going to be offering advice that would stand the test of time, that I would be able to look myself in the mirror, you know, in 2020 and say, yeah, I did right by those people. That was really good advice. And so far I've been proven correct on this. Anyway, long story, cut it short, she started buying Bitcoin as it was going down, and she bought it first, she said, at like 75 cents, and it went down to about 30 cents, and then she's been buying it ever since. She's got a lot of Bitcoin, because she didn't trust banks. She didn't know what else to do. She said she was, you know, old retired teacher. She didn't want to have stuff in her apartment that people could steal, so she wanted something that people couldn't steal, and she really liked the idea that they couldn't steal her Bitcoin as long as she kept the key in her head. So anyway, she has a lot of Bitcoin. And she wrote to me recently and was thanking me for this, saying, thank you for getting me into Bitcoin. I rode that Bitcoin down on the way. When she was starting to buy, I was writing it down from like $30, and it went down to, I don't know, well under $1, and then bounced right back. So, guys, Bitcoin crashes are nothing. Anyway, so she's been through a couple of them with me, and she just wrote to me a little while ago saying that, you know, she's really profited from this and she needed some more advice. She made some more money off of some other information in one of my reports and wanted to know what to do with it, because, as she said, she's got to get the money off the table. And so I'll tell you in a minute what I wrote to her. So now my second example is from somebody who profited by not doing something, okay? And this is happening in real time, more or less, as I'm recording this today, Saturday. This was a guy who is a retired fellow. He's living in Puerto Rico. He and his wife were scheduled to go on a Caribbean cruise, and he just wrote me an email. He got it like 20 minutes ago. And he said he had a queasiness, a funny feeling in his gut. They were supposed to go a couple of days ago, and he said, no, he said, you just didn't feel right about it. He got up that morning, and he thought he was actually going to be sick, but he felt fine, really sort of fine the day before, but it just kept coming on him, and it kept being associated with them going. So he told his wife about this, and she says, well, they didn't have to go, and by the way, wasn't it funny, because the reports that she'd been reading, she just bought this last August Alta report, talked about a Caribbean cruise ship fire. And that really set him off. He didn't really read the report so much. You know, he did when she insisted, but he kind of thought she was a loon. Anyway, not so much anymore. Because, of course, as he says here, let me see, he said they decided to give in to the funny feeling and not go. And so and the next line says, he and his wife were able to stay home and watch their cruise ship burning live on TV in real time as people were being rescued by helicopters. And he said that, that would have been us. So anyway, so he was very, very appreciative, and he said, he's not going to give his wife any trouble for reading the reports in the future, and he's going to start paying attention to them. The reason he wrote, he actually said it was the best decision that he'd made listening to her in 23 years of marriage. But anyway, he was emailing to ask about their next trip because they've got one planned for this fall. And I'll tell you in a minute what I told him. Actually, more to his wife. But anyway, so now my third example is also still happening. All right, and this one is more of an opinion. And I'll just tell you flat out, I don't have any email from these guys yet. But there were 2 readers that are currently on the other side of the flood wall in Louisiana. And these guys had contacted me maybe 3 months back, maybe even a little longer. I'd have to really go and look it up. And they were asking about conditions that were going to affect their region specifically. And because I was sort of in a holding pattern with my data processing at the time, I did a quick little check of some of the reports, took out a bunch of the snips from some old reports, put them all together in an email, and just said, here, guys, have at it. And they sent me back some email, and they just were going crazy about all the stuff that was going to affect their region potentially. And so the one guy on the end, like I said, a couple of months back said, well, this really cemented their decision because they felt they're young kids. They're in their 20s, early in life, young kids themselves, and they've got children, they've got mates, they've got to be responsible adults, and basically they just kind of wondered, were they heading in the right direction with this? Because any risk you take in a time of economic stress like we're in now may be one you can't recover from. So you really need to think through this stuff, right? Anyway, and so these 2 kids, independently of each other, had written to me, and I sent the same thing back to each of them, and because they were within like 40 miles of each other, said, hey, how about if I swap emails for you 2? And they said, sure, they'd be glad to. And both of these guys, as I say, were young guys that read, and so I swapped emails, and they connected and had told me that they were going to start working on their preparations together. And I thought, okay, this is really cool. Well, now neither one of them are reachable because